What's up everybody? It's Pablo here and welcome back to the channel. Today we're diving deep into the world of financial statements to uncover the 10 key metrics you absolutely need to analyze profitability in 2024. Whether you're an aspiring entrepreneur, a seasoned investor, or just someone who wants to take control of their finances, this video is your secret weapon. Let's jump right in and start decoding those financial statements. Before we jump into the nitty-gritty of specific metrics, it's crucial to understand why profitability even matters. Revenue is vanity. Profit is sanity. Profitability metrics act like your financial X-ray, giving you a clear picture of how efficiently a company is turning revenue into actual profit. They help us understand a company's cost structure, its pricing power, and its overall financial health. Let's talk about gross profit margin. It shows profit per dollar of revenue after direct costs. Sell handmade candles for $20, materials cost $5. Gross profit is $15. Margin is 75%. High margins indicate strong pricing and healthy profits. Different industries have different average margins. Software companies often have higher margins than retail. Compare margins to industry peers for true performance. Now, let's move down the income statement to the operating profit margin. This metric factors in not just the direct costs of goods sold, but also the operating expenses required to run the business. The operating profit margin tells you how much profit a company generates for every dollar of revenue after covering both direct and indirect costs. A higher operating profit margin generally means the company is managing its operating expenses well and squeezing more profit out of each dollar of revenue. Compare a company's operating profit margin to its industry peers to get a true sense of its performance. Finally, we arrive at the bottom line, the net profit margin. This metric shows you how much profit a company keeps for every dollar of revenue after accounting for all expenses. The net profit margin is the purest measure of a company's overall profitability because it considers all the factors that impact the bottom line. A high net profit margin means the company is incredibly efficient at converting revenue into actual profit, even after accounting for every single expense. Look at the trend of the net profit margin over several years to get a true understanding of the company's long-term profitability. Let's talk about return on assets, or ROA. It shows how much profit a company generates for every dollar of assets. A higher ROA means more efficient use of assets. Asset-heavy industries like manufacturing have lower ROAs than asset-light industries like software. Next up, we have return on equity, or ROE. This metric measures how effectively a company is using its shareholders' money to generate profits. A high ROE is generally a good sign for investors, indicating that the company is using its equity financing effectively to generate a healthy return. However, ROE can be influenced by a company's debt levels. A company with a lot of debt may have a superficially high ROE because it's using leverage to amplify its returns. Analyze a company's debt situation alongside its ROE to get the full picture. Now, let's talk about earnings before interest and taxes, or EBIT. EBIT focuses on profits from core operations, excluding debt financing and tax obligations. It's useful for comparing companies with different capital structures or tax jurisdictions. By excluding interest and taxes, we see how efficiently a company runs its core operations. Now, let's talk about earnings before interest, taxes, depreciation, and amortization, or EBITDA. This metric takes EBIT a step further by adding back non-cash expenses like depreciation and amortization. By adding them back, EBITDA gives us a better picture of a company's cash flow from operations. EBITDA can be particularly useful when evaluating companies in capital-intensive industries that require significant upfront investments in property, plant, and equipment. Because these companies have large depreciation expenses, their net income may not accurately reflect their true cash-generating abilities. EBITDA helps to bridge that gap. Now, let's move on to the debt-to-equity ratio. This metric compares a company's total debt to its shareholder equity, providing insights into its financial leverage and risk profile. A high debt-to-equity ratio generally indicates that a company is using a significant amount of debt financing, which can amplify its returns but also increase its financial risk. When analyzing the debt-to-equity ratio, consider the industry in which the company operates. Some industries, like utilities, naturally have higher debt levels due to the capital-intensive nature of their businesses. Other industries, like telecommunications, also exhibit this trend. However, for other industries, a high debt-to-equity ratio could be a red flag, signaling potential financial instability. Last but not least, let's discuss the current ratio. This metric compares a company's current assets to its current liabilities, providing insights into its short-term liquidity position. A current ratio above 1 is generally considered healthy, indicating that a company has more current assets than current liabilities. However, the ideal current ratio can vary depending on the industry. Some industries, like retail, naturally have higher current ratios because they have a lot of inventory that can be quickly converted to cash. Other industries, like manufacturing, may have lower current ratios because they have longer cash conversion cycles. There you have it, folks. The 10 key metrics you need to analyze profitability like a pro. By understanding these metrics, you'll be able to make more informed investment decisions and assess the financial health of businesses. For a deeper dive into each of these metrics and to access even more valuable financial insights, head over to my blog. If you found this video helpful, be sure to smash that like button, subscribe to the channel, and drop a comment below with your thoughts or any questions you might have. Until next time, stay informed, stay invested, and keep crushing it.